Before we get started, I would appreciate if you could subscribe to my YouTube channel. Thank you. Hi guys, what's up everyone? Welcome back to my channel. So in this video, we're going to be discussing this article, CBDC could be Holy Grail of cross-border payments. ECB sees Bitcoin as less credible. So we're going to be going through quite a lot in this video, and it's based upon this article, but this article is based upon this European Central Bank work paper series, and I'm going to be reading through it, summarizing it, because it's 59 pages, so I'm not going to read every single page, of course, but the whole point of this document is they're trying to find the holy grail of cross-border payments. So if you look at this article, they're saying that the CBDC could be the holy grail of cross-border payments. Now, we're going to go through the document ourselves in this video, and you can tell me whether they're talking about CBDCs when they're discussing the potential holy grail of cross-border payments. This article came out on August 2022, so it's a recent article, and let's go through the abstract. So the holy grail of cross-border payments is a solution allowing cross-border payments to be immediate, cheap, universal, and settled in a secure settlement medium. So bear that in mind. This is what they want from the cross-border payments. So whatever the holy grail is, it needs to be immediate, provide immediate payments, cheap payments, universal reach so that it can cover everywhere around the world, and it needs to be able to settle in a secure medium like central bank digital currencies. So the search for such a solution is as old as international commerce and the implied need to pay. So this paper describes current visions how to eventually find this holy grail within the next decade. So they're trying to find the holy grail within the next decade, namely through these types of payments. So modernized correspondent banking, emerging cross-border fintech solutions, Bitcoin, global stablecoins, interlinked instant payment systems with FX conversion layer, interlinked CBDC with FX conversion layer. This document is basically going to be going through each one of these types of payment methods to see which one is likely to be the holy grail of cross-border payments. So they're trying to go through these methods to find the solution and the most suitable solution for cross-border payments to improve it significantly, and some could even be the holy grail. So what's the holy grail of cross-border payments? So I'm going to skip through the introduction. You talk about there's two types of cross-border payments, and these include payments between non-financial corporates, businesses serving their customers following a sale or purchase of goods, or payments disposed for other reasons. So cross-border retail payments. And then the second one is wholesale cross-border payments. Now, which two cryptocurrencies do we know that can solve these two types of payments, these two areas? Now, cross-border retail payments, we know XLM is designed for that, and wholesale cross-border payments are high-value transactions. And these are payments that happens between banks and financial institutions where it's not retail payments. Because it's institutions making the payments, the transactions are high value. And which system do we know today that can do that? We know XRP is designed for that. So a second important distinction for all cross-border payments is the one between those involving a cross-currency FX conversion and those which do not. So there's two types of cross-border payments, one that has a FX conversion layer and one that doesn't. So we're going to continue with the article. The holy grail of cross-border payments is a solution which allows cross-border payments to be immediate, cheap, universal in the sense of covering ideally every addressable party in the world and settled in a secure medium such as central bank money. So this is the criteria. This is what they want from the holy grail of cross-border payments. Now, the first method of cross-border payments they're going to discuss is correspondent banking. So I'm going to give a brief summary. So correspondent banking is basically the current method used today for cross-border payments, and that involves currency being tied up, as I mentioned, in nostro-vostro accounts. And I'm not going to go into depth how that works in this video because I've already done a video explaining how our current banking system works. Check out my video called Legacy System versus ISO 20022 Standard. That would go into more detail on correspondent banking. So with that being said, even if we had a modernized version of correspondent banking, So with that being said, even if we had a modernized version of correspondent banking for cross-border payments, it would still not tick all the boxes to provide immediate, cheap, and universally reached payments. It will still be a lengthy, inefficient process for payments compared to other better solutions. So it will still remain a layered network and therefore will retain shortcomings related to completing payments through multiple intermediaries. In other words, a layered network is slow, it's not going to be fast, it's not going to be immediate, and it's basically not going to be the solution or the holy grail for cross-border payments. Now, the second payment method is the fintech solution, so emerging cross-border payments using fintech solutions. Fintech solutions would be described as things like PayPal or e-money payment service providers, companies like PayPal, Wise, Skrill, Revolut. These are all fintech solutions that can potentially be used for cross-border payments. These sort of companies are basically classed as closed loop systems. As mentioned in the article here, this document, it said this second model is a closed loop. So they refer to these systems as closed loop systems. And what they mean by that is that they work as a single central payment service provider, providing payments via closed loop system models. Now, these closed loop system models are not really going to be a solution for a worldwide solution for cross-border payments because it's not going to be feasible. The reason being is because the systems are closed loop, it would require everyone around the world to all use the same payment service provider company, which is not practical and would lead to a concentration risk. So imagine, for example, PayPal was going to be the solution for cross-border payment. It's a closed loop system. It's a single central payment system, which is closed loop. So everyone around the world, all countries around the world, would basically need to use PayPal for cross-border payments. And is that going to happen? No. So these closed loop systems, even though they do have a place in the market for cross-border payments, they're not going to be the solution for cross-border payments with the way in terms of being the holy grail for cross-border payments. And there would be a concentration risk as well. So imagine PayPal being the company that is providing cross-border payments worldwide for every single country. Just think about how much concentration that company would have. Now, the next method they talked about is unbacked crypto assets such as Bitcoin. Now, the Financial Stability Board doesn't consider the FSB unbacked crypto assets like Bitcoin as a suitable means of cross-border payments. Now, this document only refers to Bitcoin when it talks about cryptocurrency, as it's the most prominent unbacked crypto asset, but most of their analysis would apply to other unbacked cryptocurrencies, as they state in this paper. So they're just going to talk about Bitcoin, but they're saying any other cryptocurrency that's unbacked this analysis that they give on Bitcoin would also apply to said cryptocurrency. So we'll continue with this. I'm not going to talk about the settlement mechanics, but we'll skip that and we'll go down to the conclusion. So can Bitcoin be the holy grail of cross-border payments? So the Bitcoin network, completed by additional layers such as the Lightning network to ensure speed and capacity, assuming that these are effective, may have some properties which would seem to make it potentially suitable to be the holy grail of cross-border payments. So these are some advantages. So one single system can be used as is for the entire world, i.e. no further interlinking is necessary. Cross-border payments in Bitcoin appears as efficient as domestic payments in Bitcoin, without any further investment needed. This is also because the FX conversion takes place outside the Bitcoin solution. The absence of intermediaries, so there's no intermediaries, suggests a high potential for efficiency. So these are the benefits. The wallet providers have in the meantime developed relatively efficient on and offloading services from domestic currencies into Bitcoin. Now, some of the drawbacks: the underlying technology, and in particular its proof of work layer, is inherently expensive and wasteful. Remember, we're moving into a carbon neutral narrative, and they want the solution for cross-border payments to also be carbon neutral. They don't want something that consumes energy, and Bitcoin consumes too much energy, and they call it expensive and wasteful because it's proof of work. And they go on to say, much of its perceived attractiveness for cross-border payment stems from having escaped so far an equal regulatory treatment in terms of KYC, AML, CFT compliance. And this is something important as well. Whatever the solution for a cross-border payment is, it has to be compliant with regulation, such as the KYC, know your customer, anti-money laundering, CFT, combating financing of terrorism, something like that, compliance. So it has to be compliant with all of this, and it's basically saying Bitcoin isn't. There'll be governance issues. Its price volatility makes it unsuitable as unit of account. They're saying Bitcoin basically is too volatile to be a suitable unit of account. So in conclusion, Bitcoin is unlikely to be the holy grail of cross-border payments, primarily for three reasons. First, its underlying proof of work mechanism is inherently inefficient, wastes too much energy, and it's expensive. Second, the supposed comparative advantages in cross-border payments are the result of regulatory gaps, which will, however, be closed as authorities realize that these gaps have significantly undermined the effectiveness of AML CFT regulation and have supported Bitcoin as predominant global means of illicit payment. So they already see Bitcoin as something that is allowing illicit payment because it does not comply with AML CFT regulation at the moment, which is something that they also want to remedy. So the third, Bitcoin is not even suitable as domestic payment systems. It is not even suitable as domestic payment system because it is inherently unstable. So they're saying also because of the volatility, it's unstable in terms of its purchasing power. By the looks of it, Bitcoin as well, they don't consider Bitcoin as a viable solution for cross-border payments. But it's something I would also like to touch on as well. They refer to Bitcoin in this article as something that's unbacked. They call it an unbacked crypto asset. And this is something that I want to touch on in relation to utility-based crypto assets like XRP, XLM, and XDC. Now, I would personally argue that those three assets, XRP, XDC, and XLM, are directly backed by their utility within their respective networks and not just speculative demand like Bitcoin is. So the more value in the form of tokenized assets that is basically going to move across these respective ledgers, whether it's XRP, XDC, XLM, the more utility-based demand there would be for the native token to facilitate the transfer of these tokenized assets. So the greater the utilization of the networks for transferring value, the greater the demand for the utility token, which subsequently increases their value, which reflects in their price. So I would not say these utility-based tokens are unbacked crypto assets. They are backed by their utility. Now, another thing I would like to add as well, and I would like to add that I got this from a crypto YouTuber by the name of T's Crypto Spot. Check out his channel. And he mentioned this, which I also agree with because it makes so much sense when you understand how the XRP system and the XRP ledger is going to work and the function of XRP. Also, I'll say all the X assets, XRP, XDC, XLM, their function within their native ledgers, how they're going to work. Now, he mentions that the X assets that have a liquidity function to it are likely going to be backed by tangible assets and or commodities to give them their intrinsic value. XRP could also be backed by tangible assets, whether it's gold, precious metals, commodities out there, a basket of commodities, whatever, to give it a intrinsic value alongside its utility aspect. Because the reason being is you have to understand that the X assets would potentially be responsible for facilitating the transfer of lots of high value transactions simultaneously. So to make the X assets efficient and safe for value transfer, they cannot just be backed by its utility alone for value. Because remember, institutions are going to want some sort of insurance, and if XRP is just backed by utility alone for value and it's going to be used to actually transfer assets of real value, but the thing that's going to facilitate the transfer is not backed by anything of value itself, that could be something that turns institutions off. To make XRP an attractive insurance system for them and to make it safe for them, XRP in and of itself is also likely going to be backed by assets or tangible assets and commodities to actually give it intrinsic value and not just utility alone, because if it was just utility alone, it could be perceived as intrinsically worthless. So therefore, to make an efficient and safe system for value transfer, the X assets will likely have intrinsic value by being backed by tangible assets and or commodities too. So they'll be used to facilitate the transfer of actual tangible tokenized assets across their ledgers, but at the same time, the token itself is likely going to be backed by tangible assets as well to give it value. This notion fits in perfectly with the idea that the X assets would need to be a stable high price in order to fulfill its purpose for institutions around the world. Now, for these X assets to work, it would not work at a low price in order to be a global liquidity neutral bridge asset that facilitates the transfer of high value payments and tokenized assets across its ledger. It cannot do that at a low price. It has to be a high price. So how could you increase the price of these neutral bridge assets? You can do it by making sure that they are backed by assets themselves, which are tangible, and increasing the price of those tangible assets and commodities, which ultimately would lead to the neutral bridge asset token X assets being increased in price and value as well. Alongside that, you have the utility for the token, which would bring a lot of demand for it as well. And all of that could be used to factor in a stable high price for these X assets so that they can fulfill their purpose in an efficient and effective manner for institutions around the world. So if the X assets have intrinsic value due to being backed by tangible assets, all they will need to do is raise the value of the X assets to reach a stable high price would be to simply hike up the value of the tangible assets that are backing them. That's what they'll need to do. That actually makes more sense to me, that they're going to be backed by tangible assets and commodities. It's like the penny dropped, because I was just solely looking at it from a utility aspect alone, that they're going to be backed by utility. But that's really not enough for institutions. Having these native X assets also backed by tangible assets, giving it intrinsic value, makes perfect sense. So I hope that makes sense to you as well. But to summarize it, the intrinsic value of the X assets would probably be directly proportional to its utility and the value of the tangible assets / commodities that they are backed by. I hope that makes sense. So with that being said, you really can't compare the X assets to Bitcoin, which is an unbacked cryptocurrency. You really can't compare the two. And also you can't compare the two when it comes to their utility, and you can't compare the two when it comes to their technology. I mean, the X assets are literally in a whole different league when it comes to Bitcoin. But anyway, let's get back to the document. So the next method they were talking about is global stable coins. Now, we know what stable coins are. Examples would be USDC, Tether, DAI, Facebook's token DM, Libra / DM. These are all examples of global stable coins. Now, the benefits of stable coins is that they have high technological efficiency, potentially high technological efficiency, economies of scale, and value stability. So these are the potential benefits of using global stable coins for cross-border payments. Now, if we're going to talk about drawbacks, there are, however, some practical drawbacks of stable coins, which include market power and network effects. And what they're basically saying, a stable coin that will be used for cross-border payments would have significant market power across international borders, presumably giving it leeway to eventually exploit this market power. So remember, a stable coin is usually brought in by a private company or a country. So imagine all the countries around the world are going to accept a particular stable coin for cross-border payments. Now, that private company who created the stablecoin would have significant market power in one way or another, because all the countries are going to be basically using their coin. And they talk about big techs could also store, use, and sell the payment data, raising privacy concerns. Now, this is not going to be a solution. It's common sense. You're not going to have America bringing out their stablecoin and a country like Russia, for instance, saying, yeah, we're going to accept your global stablecoin to do all our cross-border payments. and so on, and China as well. It's not going to happen because of market power and network effects. Do you understand? So, but what you have to understand when it comes to the X assets, they are neutral bridge assets. They do not belong to any particular country. They are neutral. No country owns them, or no institution does it belong to. It's just a neutral bridge asset that any country can leverage and benefit from, unlike a created global stablecoin. So there's financial stability issues, and this is basically liquidating the assets that back the stablecoins during massive sell-offs of the stablecoins by holders could destabilize markets, and that's what they're basically talking about. So usually stablecoins are backed by assets of value, and if those assets of value are liquidated during massive sell-offs of the stablecoin by holders, it could lead to market destabilization. Another one is risks of currency substitution. So they talk about the stablecoin can be used, if the stablecoin can be used for cross-border payments, then there is a significant risk of a country's native currency being substituted in favor of the stablecoin. And this is probably why also Facebook had so much roadblocks. Facebook had so much regulatory roadblocks when it came to their stablecoin that they wanted to introduce called DM. It was never going to be able to make it because they saw Facebook as a company that has too much reach, too much users already using their platforms across all their platforms. And if they introduce a stablecoin, then there's a risk that that stablecoin could potentially substitute the currency. So imagine America, people could use DM more than the US dollar, for example, because it can gradually start substituting it. And that's a risk that they don't like, nor do they want that to happen. So another risk is that it's a threat to monetary sovereignty. So a stablecoin issued by a foreign nation could be a threat to the monetary sovereignty of countries. For example, the foreign issuer of a stablecoin would have access to information on how the countries use their stablecoin for commercial purposes and in cross-border payments. And under political pressure, the issuer could impose sanctions suddenly on countries prohibiting the use of their stablecoins. Now, this is a clear reason why global stablecoins would never be the solution for cross-border payments, because whoever is running and in control of that stablecoin has too much power over other countries. Imagine, for example, as I mentioned, that under political pressure, the issuer could impose sanctions suddenly on countries prohibiting the use of their stablecoin. So everyone's using a stablecoin created by America. America has a problem with a country, they can start sanctioning them, prohibiting them from using their stablecoin. And also, America would have all information as to how those foreign countries use their stablecoin for commercial purposes and in cross-border payments and so on. So this sort of foreign power is a major vulnerability to the monetary sovereignty of nation states and their citizens. So forget this. This is definitely not the Holy Grail of cross-border payments. This also makes me think about an interesting point as to one of the problems that nation states will have once they all start releasing their own CBDCs. So think about this here. Every country now is going to be releasing their CBDC. And the problem that these countries are all going to have is interoperability. How does the CBDC of China interoperate with the CBDC of America? How does the CBDC of Russia is interoperable with the CBDC of Britain? So remember, no country would likely be inclined to use a centralized system for interoperability, relying upon a foreign power that could potentially create vulnerabilities for their nation state's monetary system. So when it comes to interoperability, they're not going to want to use a foreign power that could create vulnerabilities for the country's monetary system. They're not going to want to use a centralized system for interoperability. It makes no sense why they would want to do that, because it involves trust with that nation if the interoperability system is controlled by that nation. So it involves everyone, whoever controls the interoperability system, then there has to be, all the nations have to trust that state to not be a threat to them. So what's the solution? The solution would be options that leverage decentralized interoperability systems. Now, leveraging decentralized interoperability systems that use a neutral bridge asset, because these systems are not controlled by any state, any nation state. So it's not owned by any sovereign nation to make CBDCs interoperable. So a decentralized system that utilizes a neutral bridge asset to make CBDCs interoperable, which isn't controlled by any nation state, is a solution to the problem instead of using a centralized system for interoperability where countries have to rely upon a foreign power which could potentially be high risk to any country out there, creating vulnerabilities for them. So I hope that makes sense why X assets like XRP, XDC, XLM are solutions, because they are decentralized systems that leverage neutral bridge assets controlled by no nation state. So fragmentation. So they're saying that global stablecoins would create fragmentation, and the reason why they would create fragmentation is because that they are non-interoperable closed loop systems, and as a result of being non-interoperable and closed loop, it would create fragmentation, because for it to be successful as a cross-border payment solution, all nation countries would have to agree to accept to use the same system. Does that make sense? So if USDC, for example, or USDT was going to be the solution for cross-border payments, then every single country around the world is similar to the example of the fintech solutions, like PayPal. If it's going to be the solution for cross-border payments, every single country around the world would need to agree to accept to use that system for cross-border payments, which isn't going to happen. No one's going to say, okay, let me use a fintech solution for cross-border payment, and every single country around the world is going to say, okay, let's use PayPal for cross-border payments, or let's use USDC for cross-border payments, because of the risks of it being centralized and who controls it. All these countries are now creating their own non-interoperable closed loop systems like CBDCs. Every single country is creating their own CBDCs. Do you understand what I'm saying? They're all creating their own CBDCs. No one's saying, okay, we're going to accept USDC for cross-border payments. They're all creating their own closed loop systems like CBDCs. So every country has a CBDC, but the problem is now they're all closed loop. So the problem is interoperability. This all creates fragmentation because they are not interoperable, which is going to create fragmentation between them. And the only way to solve this fragmentation issue is by making all these CBDCs interoperable with each other. And which solutions do we know that can do that? Well, I can tell you this: a privately issued stablecoin by another foreign power isn't going to be the solution for cross-border payments or interoperability. And what are they likely going to use? They're going to use a system for interoperability that is neutral, that no state has control over, to solve the issue of fragmentation, in my opinion. Other problems is illicit finance concerns. So unregulated stablecoins pose a risk to the integrity of the financial system due to issues related to AML, CFT being widespread. So these are also concerns. So they conclude, one may conclude that relative to Bitcoin, stablecoins seem to have more potential to deliver the Holy Grail of cross-border payments by combining conventional and progressive technology in a pragmatic manner, and by leveraging the technological abilities and large global client base of big tech firms. So compared to Bitcoin, global stablecoins is a better solution, but it's not the solution. At the same time, the financial stability, these are the problems in the monetary policy, the strategic sovereignty, the market power, and fragmentation concerns raised by stablecoins are significant. Most nations will feel, for good reasons, uncomfortable about the prospects of a few big techs controlling global payments, as payments are a matter of strategic sovereignty, network effects, and market power. Therefore, also, global stablecoins do not seem to be the holy grail of cross-border payments. There you have it. So a global stablecoin is not going to be the solution for cross-border payments. And let's look at this article. CBDC could be holy grail of cross-border payments. I mean, seriously, it's a joke. This person, whoever wrote this article, clearly states CBDC could be the holy grail of cross-border payments, when a CBDC is basically a stable coin. It's going to be a stable coin that's created by the country rather than a private big tech institution, but it's still going to be a stable coin connected. It's a fiat currency basically that's just been digitalized by central banks. Now, for the same reason they would not want to accept big techs producing stablecoins, is the same reason countries are not going to want or accept CBDCs as a solution for cross-border payments. They're not going to accept it for the same reasons. So to say CBDC could be the holy grail of cross-border payments, that is completely wrong. CBDCs are not going to be the holy grail of cross-border payments, because the same reason is global stablecoins are not going to be the holy grail of cross-border payments, because of the risks associated with everyone accepting that global coin for cross-border payments. Countries are not going to do that, which is why they are all now creating their own CBDCs. But this is creating fragmentation in the market, because every country has their own CBDC or will have their own CBDC. So how do you fix this fragmentation to make them all interoperable? You need to have a solution, and that's the solution that is going to be the holy grail for cross-border payments. And that solution is not CBDCs, because CBDCs are part of the problem, which is creating fragmentation. So the solution is the system that dissolves the fragmentation and makes all these CBDCs interoperable. And it cannot be a system that's controlled by any state nation, because there's too much risks. It has to be a system that utilizes a neutral bridge asset controlled by no state nation, that's decentralized, that every country can benefit from, but no single country controls. I'm sorry, I'm on a little bit of a rant here, because this article's headline is a misrepresentation of the document. CBDCs could be the holy grail of cross-border payments. Interlinked instant payment systems with FX conversion layer. So currently, countries around the world, they have domestic instant payment systems which transmits messages and the funds to the payee in real time, such as RTGS payment systems. Now, countries have that domestically, but what we don't have, and what is currently being worked on, is the interlinking of all these national domestic RTGS payment systems as an option to enhance cross-border payments. And to solve the issue of long transaction chains and differing data standards in correspondent banking, cross-border payments, the plan is to migrate over to a global messaging standard, ISO 20022, and have an interlinking payment system with an integrated instant FX conversion layer. So this document here further goes on to explain that such a payment system would need to be able to interlink domestic payments through a connecting layer that transmits payment orders between them. And this payment system must have an instantaneous and cost-efficient currency conversion layer. And also, this payment system must be compliant with AML/CFT checks. Now, hearing all of this, what system do we all know that sounds like the perfect solution to do this, that fits this like a glove? So they do give examples of some systems. A number of initiatives are briefly described below which aim at interlinking instant payment systems in different currencies. And they say Nexus, go through some of these in a minute, Thailand, Singapore Retail Instant Payment Link, TIPS, RIX, Euro Approach, EBA Clearing, TCH Collaboration, Buna TIPS Experiment, P27. Now, out of all of these initiatives, I will say the most ambitious is Nexus. However, out of all of these initiatives also, all of these examples mentioned in this document, none of them are based on DLT payment systems, which are worldwide solutions for cross-border payments. Like we know we have XRP, XLM, and so on. Instead, they seem to be more of a regional solution, interlinking payment systems of certain countries or currencies together to enhance cross-border payments between them. So that's the problem I have, or my concerns that I'm raising with these initiatives raised in this document. Remember, one of the criteria was that they want a solution. The Holy Grail must have universal reach. Now, none of these sound like they have universal reach. Then we have Nexus, and I'll say out of all of them, Nexus seems more ambitious with its approach to interlinking instant payment systems and having a FX conversion layer. for cross-border payments. However, if you go to their blueprint document, and I went to their blueprint document here, where it basically talks about Nexus, and by the way, this is not a DLT, distributed ledger technology approach. I think it's more of a centralized system. There is no neutral bridge asset. There is no DLT tech. It's just a centralized system that's with an FX conversion layer by market makers that they're using for cross-border payments, where basically every bank has to basically use the software that they provide, and they have to go through Nexus, and Nexus has connections with banks or financial institutions that provide FX conversions, and it just helps create a currency conversion between one country and another country without using distributed ledger technology. Every bank would have to basically connect with Nexus. Now, is that a global solution? I don't know. I don't think so either. So, what another reason why I'm going to say it's not a global solution, because if we go to their document, it says Nexus. Let me see if I can find the part. So the Nexus network is made up of the following participants and actors. So it says in this document that Nexus is not designed to be used to make payments between very large corporates or financial institutions. And here, Nexus is not designed to be used to make payments between very large corporates or financial institutions, so-called wholesale payments. So how is Nexus going to be a solution for cross-border payments, where banks around the world are sending over high-value payments between each other, wholesale payments, when Nexus is not designed for this? What is Nexus designed for? Nexus is designed for retail payments, smaller payments between individuals, small or medium-sized businesses that are doing retail payment transactions, which is a solution that XLM is tackling. But it's not designed for wholesale payments between corporates or financial institutions. Yeah, so Nexus is not designed for sending of high value payments, rather it's more for the retail payments from individuals or small or medium businesses. So bearing that in mind, I'm beginning to wonder at this stage, are they deliberately not mentioning one of the best solutions at interlinking instant payment systems with FX and a CBDC conversion for cross-border payments worldwide? It's clearly not Nexus, and it's not the TIPS and RIX Euro approach. It's not the Thailand Singapore approach. It's none of these initiatives that they mentioned. So why are they not mentioning the best solution that we have, that we know of, that is distributed ledger technology based, that can basically interlink instant payment systems, and it has an FX and CBDC conversion for cross-border payments worldwide? And this solution also caters for AML, CFT compliance. How come it's not mentioning it in this document? The benefits of a system that can interlink instant payment systems and that has an FX conversion layer is that it is efficient. It preserves competitiveness as it enables strong competition between FX market makers. It has universal reach. It does have universal reach in theory, but the initiatives that they've mentioned in this document, I don't see any of them having universal reach. But in theory, yes, such a system should have universal reach. And the monetary sovereignty is preserved because interlinking payment systems prevent currency substitution. So it goes back to the CBDC example. When you create a system that makes every CBDC interoperable with each other, then that basically prevents there being a threat to currency substitution, compared to if you were basically going to use a global stablecoin for cross-border payments, which could be a threat to currency substitution. But if you're going to have a system that just makes every CBDC or every currency interoperable with each other, then it eliminates the threat of any currency substitution happening. And the global power of a few dominant payment firms. It also eliminates the threat of a few dominant payment firms having all the global power. So what are the potential drawbacks of having such a system? Now, that's what they say. Interlinking will probably not be a solution for very narrow cross-border payment corridors in which the cost of the interlinking will be relatively high, and it will be difficult to organize sufficient competition within the FX conversion layer. Now, I see this problem that they raise only being an issue with non-DLT based interlinking payment systems, like the initiatives that they mentioned in this document, which do not have a neutral bridge asset that can be leveraged for liquidity in cross-border payments. Because if you are going to use a neutral bridge asset for liquidity, like one of the X assets, then it would not matter how narrow the cross-border payment corridor is between two fiat currency pairs. And the reason why I say this is because let me give you an example. If there is not enough liquidity or enough competition for the FX conversion of two direct fiat currency pairs, so imagine we have the dollar and we have the Zimbabwean dollar, for example, or whatever the currency is. Now, there is not enough liquidity or competition for there to be an FX conversion between these two currencies in these centralized systems. So if you're using a DLT-based system with it that has a neutral bridge asset, then on a DLT-based system, the currency X, which is the US dollar, could be converted into the native bridge asset token, in this case XRP for example, and then sent to its destination whilst being converted into the currency, the Zimbabwean dollar. So between the currency pairs, like the dollar and the Zimbabwean dollar, there is no liquidity between the two pairs directly. But both currencies have lots of liquidity and volume between them and the native bridge asset token, like XRP for example. So this is why a neutral bridge asset is important, because they're saying that for very narrow cross-border payment corridors, these initiatives won't be a solution. But when you have a neutral bridge asset that's on DLT and all the world currencies have high volume with that neutral bridge asset, then any currency, okay, even though they may together may not have a lot of liquidity directly, can be converted into the neutral bridge asset, which acts as a liquidity token, which acts as a means of providing liquidity in the market, and that neutral bridge asset can then be converted into any given currency. So this is why this only works with a system that is DLT based, that is leveraging a liquidity token. So therefore, interlinking systems that is DLT based with a native bridge asset liquidity token is a much better overall system than the ones that are solely just relying on there being enough liquidity between currency pairs by FX conversion service providing banks. And this is what the Nexus system is relying upon. The Nexus system here is basically relying upon there being liquidity provided by FX conversion service providing banks. Now, if there is not enough liquidity provided by these banks because the corridor is narrow, there's going to be a problem because it's going to be expensive and it's going to be difficult to organize competition. However, when you have a DLT-based system, even if for example, the dollar and the lira, there is no liquidity between these two currencies because the corridor is too narrow. So the Nexus system won't work. However, we have a distributed ledger technology that is leveraging a neutral bridge asset like XRP, XLM, XDC. Now, this neutral bridge asset is a liquidity token. The US dollar has a lot of liquidity with XRP and the Turkish lira has a lot of liquidity with XRP, but they don't have liquidity directly with each other. So we have this solution. Nexus system cannot provide the solution because there is no neutral bridge asset. They're relying upon FX conversion service providing banks, and those banks are not providing enough liquidity between these two currency pairs. So we have this neutral bridge asset system, which is DOT based, and all it does is convert the US dollar into the native bridge asset token, liquidity token. In this case, let's say it's the XRPL blockchain. It'll be converted into XRP, and then XRP will be sold or converted into lira, and it can do that instantaneously because there is enough liquidity between the lira and XRP and the USD and XRP. So it's the solution for narrow exotic corridors using a DOT-based system, neutral bridge asset, liquidity token. So these non-DOT-based cross-border payment systems like Nexus would only work well with more important major corridors. It's only going to work well between major corridors like the euro and the US dollar, the British pound and the US dollar, the British pound and the euro. With these corridors, there's a lot of liquidity and volume between the two major currency pairs, whereas a DOT-based system would be the cheapest solution for all types of cross-border payment corridors by leveraging their native neutral liquidity bridge asset, which this Nexus system cannot do because it does not have one, like XRP, XLM, XDC. And I hope that makes sense. So let's move on. And the next thing is interoperable CBDC with FX conversion layer. And this is basically a system that would be able to interlink all CBDCs and make them interoperable between each other by being able to instantly convert between them. It says the interlinking of CBDCs basically is as promising to achieve the Holy Grail of cross-border payments as the interlinking of domestic fast payment systems. This is subject to making AML compliance instantaneous. So they're basically saying that if you can make AML compliance instantaneous, and then this system of interlinking CBDCs is just as promising for cross-border payments as being able to interlink all domestic payment systems and have an FX conversion layer for the Holy Grail. And that's what they basically say here. The Holy Grail whereby cross-border payments can be immediate, cheap, universal in terms of reach and settled in a secure settlement medium such as central bank money is in reach for the first time. This is thanks to the rapid decline in the cost of global electronic data transmission and computer processing, new payment systems technology allowing for instant payments, innovative concepts such as the interlinking of payment systems, including a currency conversion layer or CBDC, and unprecedented political will and global collaboration like the G20 work on enhancing cross-border payments. So they're saying this system, the Holy Grail, to provide this criteria, immediate, cheap, universal payments, is in reach. Now, the review of various visions as to how to achieve the Holy Grail suggests that Bitcoin is least credible. To all the Bitcoin maxis out there, they're telling you that Bitcoin is the least credible. They're not going to be using Bitcoin. It's a waste of energy. It's slow. It's antique tech when it comes to other distributed ledger technology systems out there. And it's not in line with their carbon neutral agenda. Okay, so Bitcoin is the least credible. Stable coins, traditional correspondent banking and cross-border fintechs take an intermediary place. So global stable coins, which we're not going to use either because of the risks that it poses in other nations, and also it creates fragmentation because it's closed loop. The same with traditional correspondent banking. We're using that today. There's no way they can improve it to make it any more better to solve the problems that we have with friction and long chains. I mean, this solution is not going to work either. And cross-border fintechs, we've already went through this in the document why this is very unlikely as a solution. And they're saying they take an intermediary place, but may all contribute to improvement over the next years. So even though there are some elements where they are advantageous for cross-border payments and they can contribute to improve it, is it really going to be the Holy Grail? And it goes on to say, from a public policy perspective, stablecoins appear somewhat more problematic than the other two options as they aim at deep closed-loop solutions. They're closed-loop solutions, centralized closed-loop systems, market power and fragmentation. Two solutions, the interlinking of domestic instant payment systems and future CBDCs. So the system that can interlink domestic instant payment systems as well as CBDCs, both with a competitive FX conversion layer. So this system can not only interlink all these different payment systems domestically, and it can also interlink all the CBDCs that banks create, and it also has an FX conversion layer. This system may have the highest potential to deliver the Holy Grail for larger cross-border payment corridors. What does this say? CBDC could be the Holy Grail of cross-border payments. Nope. The ECB did not say CBDCs could be the Holy Grail of cross-border payments. What the ECB said is that a system that can interlink domestic payment systems as well as interlink CBDCs together, and this system must also have an FX conversion layer, that is going to be the Holy Grail of cross-border payments. So it's not talking about CBDCs, but it's talking about a system that can facilitate the interoperability of CBDCs between one country and the other, and it has the ability to provide an FX conversion layer between these CBDCs. This system could be the Holy Grail. So this article's title is wrong. The only part they got right is that sees Bitcoin as less credible, but everything else here was wrong. if you want to be more accurate, you might as well just say the DOT-based systems that leverage XRP, XDC, and XLM could be the holy grail of cross-border payments, and it sees Bitcoin as less credible, even though the ECB did not come out and say they are the holy grail of cross-border payments. But when you look at what they're describing, they are basically describing, what are they describing? They're describing exactly what the Ripple XRP ledger technology can do. They're describing what XLM technology can do. They're describing what XDC technology can do. They did not mention those in the article, in this document. But what they're describing are those systems. And they also say that these systems may have the highest potential to deliver the holy grail for larger cross-border payment corridors, as they combine technical feasibility, relative simplicity in their architecture, and maintaining a competitive and open architecture by avoiding the dominance of a small number of market participants who would eventually exploit their market power. Moreover, monetary sovereignty is preserved with these systems, and the crowding out of local currencies is avoided due to FX conversion layer at the border, which does not hold for Bitcoin and global stablecoins. Now, Bitcoin and global stablecoins do not have an FX conversion layer at the border, but what does have that? The XRP ledger technology. It's an on-demand liquidity token. It has that conversion layer. It sends the message and it can convert the currency, the CBDC. It makes it interoperable. And it says, finally, the solutions require that strong progress is made on the AML CFT compliance side. So basically this system as well that can interlink all these systems together, all these payment systems. Remember, they're talking about an infrastructure here. A system also has to be AML and CFT compliant. Now, I just want to go through quickly. This is on the Ripple page. And what does it say? It's Ripple talking about compliance. At Ripple, we understand that compliance and risk management are critical to your bank, which is why we build solutions that offer greater visibility into and control over cross-border settlement. Ripple offers seamless integration with your banking existing systems. See what I'm talking about? The systems that they provide here? Seamless integration with your bank's existing systems. That basically they're telling you that we can interlink all your domestic payment systems together. We can do that for you at Ripple. We can interlink exactly what the ECB document is describing for the Holy Grail. Ripple is coming out and saying we can interlink all your domestic payment systems. Ripple offers seamless integration with your bank's existing systems and processes, and it says such as anti-money laundering controls, fraud detection, sanction screening, and regulatory reporting. So Ripple also provides what they want. They want a system that's in compliance with AML and CFT, the combating of the financing of terrorism. And they want this system to be automatic within the interlinking process. And Ripple is saying that they can do that. Ripple makes it efficient for your financial institution to meet compliance requirements while reaping the benefits of real-time settlement. And that's what they want. They want a real-time settlement solution. While financial institutions integrating Ripple remain responsible for employing their own compliance measures, Ripple offers a way for your bank to reduce operational and risk management costs. Exactly what the ECB, European Central Bank, wants for the Holy Grail in cross-border payments. They want it to be AML CFT compliance. They want it to be able to interlink domestic payment systems and CBDCs, and they wanted to have an FX conversion layer. And Ripple right here is basically saying we can do all that for you. In my opinion, it is very apparent from this document that the system they are describing to be the Holy Grail for cross-border payments that is able to interlink domestic payment systems and CBDCs with an FX conversion layer built in is basically what DLT-based RTGS payment systems can do, which utilizes bridge assets like XRP, XLM, XDC for interoperability and liquidity purposes. Now, the document did not mention any DLT-based cross-border payment systems at all. In this document, they gave examples of some initiatives, but none of them was DLT-based. But practically, what they describe is basically describing them when talking about the most efficient cross-border payment solution, which could be the Holy Grail. They are basically describing DLT-based systems despite the fact that they didn't mention any in this document. And I'm going to go as far as say this is probably deliberate. I don't think the European Central Bank is unaware or ignorant to distributed ledger technology solutions for cross-border payments. They are very aware of it. So the fact that they didn't come out outright and say these are the systems that can actually be the solution and be the Holy Grail is probably deliberate, where they leave it ambiguous on purpose. But what they do, however, is describe the tech just enough for someone that is aware of it to know what they are describing, because it fits the sleeve of a DLT-based solution using a neutral bridge asset like XRP, for example. And I don't think they want to outright come out and say the XRPL or the Stellar Network are the holy grails for cross-border payments, because the idea is not to tell us or let us know explicitly before they flip the switch. Before they flip the switch to these currencies, before they flip the switch of XRP, XLM, XDC, the idea is not to come out and tell us, oh, guess what? These solutions are the holy grail for cross-border payments. Rather, the idea is to be ambiguous, have retail investors uncertain, let us sell our bags cheap, let the market for these assets tank, but ultimately they plan to one day soon utilize DLT systems. And they plan to one day soon flip the switch, and those weak-handed holders would be priced out once that happens if they sold too early, leaving those still holding the opportunity to potentially become very wealthy as institutional money pours into these X assets, mopping up the circulating supply. So the title of this article should be Ripple, Stellar, Zinfin could be the holy grail of cross-border payments. That's what the title of this article should be. Anyways, thank you guys for watching. Don't forget to like, subscribe and hit the bell notification icon so as to not miss my next video. Take care and goodbye.